This is Matthew Cratter from Trade University, and today I want to talk about the worst investment mistake that you can make if you're investing in an environment of high inflation or even hyperinflation. And this video is a follow-up to yesterday's video where we talked about what happens to stocks and real estate and gold and other assets like this in an example of hyperinflation. And we came up with a counterintuitive result by looking at places like Zimbabwe and Venezuela and Argentina, for example, that the stock market actually tends to do really, really well when an economy goes into hyperinflation and the stocks go up a lot. They don't go up as much as the currency is going down, but here we can see an example of one of the great modern cases of hyperinflation, which is Zimbabwe, and the stock market has gone straight up over the past few years. So when a currency dies, asset prices go up a lot if they're denominated in that currency. As we said, stocks, real estate, gold, and presumably Bitcoin as well, which we've seen, for example, with the Lebanese pound in a previous video. Now, one obvious way to go bankrupt when there's a lot of inflation, as we talked about yesterday, is to own bonds, including government bonds like treasuries, or to keep piles of cash under your bed or in the bank. These are the two worst investments you can make when there's very high inflation. And if you don't understand why that's true, you can watch yesterday's video to learn more about that, and I'll link in the description notes below. But let's say that even if you know that you should own assets like real estate, stocks, gold, and Bitcoin, especially Bitcoin, in an environment with high inflation, there's still a way to really mess things up. And this was a reminder that I got from S. Morgan 125's comment yesterday. A good question. This is why I don't understand why you're not a fan of TQQQ and UPRO. If you think hyperinflation is imminent and stocks will soar, then why not leverage up? As I discussed yesterday, I do not think that hyperinflation is imminent, is about to happen in the US in the next couple of years, but I think it is the end game. And this is what happens to all currencies. All fiat currencies eventually hyperinflate. So he's asking, why not use leverage? If you think the stock market's going up, for example, why not use these leveraged ETFs that are 3x leverage on the QQQs, and UPRO is 3x leverage on the S&P 500. So in this video, I'm going to give an explanation of why you do not want to use leverage in a high inflation environment, even if you're correct that asset prices are going to go up a lot. And the example we're going to use again, as we used yesterday, is the Weimar Republic, which had very, very high inflation in the late teens and early 1920s. Here's the famous picture where it would require an entire wheelbarrow or even an entire truckload of paper money to buy a loaf of bread. This is what eventually happens to every currency. And so, of course, the easy solution to this, if you were sitting in Weimar and you had perfect foresight and you had perfect self-control, just buy some gold and sit on it. Don't trade in and out. Just buy and hold. And this would be a way to preserve your purchasing power when everything else is hyperinflating. We can see here, for example, that the price of gold, this is actually the gold mark expressed in paper marks, but it's essentially the price of a certain amount of gold expressed in paper currency. We can see here that it went from approximately 1 in 1918 to 1 trillion just a few years later, about 5 years later. Now, this would make you think that this is a very easy investment. You just buy gold, you use a lot of leverage, and you hold on. But if you take a look at what the monthly returns look like, and this is a chart that I've posted here a few times. This is from Mermercon Research, and it's one of the most interesting charts I've ever seen. We have the gray line here, which again shows the price of gold in Weimar marks in the local fiat currency, going from 1 to 1 trillion. But this blue line, this oscillating blue line, is the percentage monthly change in gold price. So this gives you a better idea of the path rather than just looking at the big abstracted picture. And we can see here that there were huge swings. So here's 80%, for example. We had many monthly swings that were over 80 and even up to 160%, but we also had huge down months. And there's no scale here, but this looks to me like this is 20, 30, 40% down. So the problem with using leverage is, even if you're correct about this path, that you're going from 1 to a trillion, the path really matters, especially if you're using leverage. And this is why you don't want to use leverage in a hyperinflationary environment. If you're finding this video helpful so far, I just ask you to hit that like button, hit the subscribe button to this channel. That will really help with the algorithm. So let's just do a quick reminder what happens when you have a drawdown, when you lose money on a position, and when you're down a certain amount, how much you need to make back. And this is, of course, relevant to this chart. So let's say you're starting at 100, the index or the stock is at 100. If you're down 10%, you need an 11% rally to get back to even. So that'd be going from 90 back up to 100. If you're down 20%, unless, in other words, if you're at 80, you need a 25% rally to get back to even. Down 50%, you need a 100% rally. Down 90%, you need 1,000% rally to get back to even. So this is how compounding works, and this is one problem with being really far down on a position. This is made even worse if you're using leverage. So in this trade or in this investment, if you just invested cash, you might be able to hold on and ride the asset back up, as many of us have done with Bitcoin being down 75% or so since from peak to trough. If you're not using margin or leverage, if you just did a cash investment, you might be able to hold on and ride the asset back up if you have the psychological strength and you still have the conviction in your investment. So for example, being down 75% for the peak in Bitcoin, it's not a good feeling, but if you understand the fundamentals, you're able to handle this. But if you borrowed money to invest, in other words, if you invested in stocks or Bitcoin or anything else, using margin, using leverage, these are different words for the same thing, where basically you borrow some money, you put up some cash, and then you borrow some money from your broker, and you use that to create a leverage position. If you borrow money to invest and you have a large drawdown, like one of these drawdowns, you're going to need to come up with fresh capital. Otherwise, your broker is going to force you out of the trade. They're going to stop you out of the trade, and it won't matter if the asset eventually goes back up to where it was, because you'll no longer be in there. You will have blown up your account. So this is a very important investing principle, and it's easy to lose sight of this, especially when you gain high conviction about what you think is going to happen in the future, which itself you have to be careful of course. But this is the important investing principle. If you can't stick to a trade, you will not get the reward. It's very, very obvious, but it does bear repeating. Trading, as we said, is always path dependent. And so when you think it's going to be like this, it's actually going to be like this. And this is, a lot of people are jealous of early holders of Bitcoin, and they said they made money in a very easy way. They think holding Bitcoin was like this, but holding and hodling Bitcoin is more like this blue line. If you use leverage, you can be right about the outcome, but still lose because the market dips and takes you out before blasting higher. This would be the worst thing. Imagine being right about gold in the Weimar Republic, using leverage to try to profit from this, and then getting wiped out like everyone else because you get stopped out in one of these large monthly drawdowns. Now, if we take a look at Bitcoin, it's certainly had its share of enormous drawdowns. Here's one from 2011, peak to trough of 93%. As I said, the most recent one that we seem to be emerging from, the peak to trough number, was 76.64% from the peak in November 8th, on November 8th, 2021, to the bottom on November 20th, 2022. And we can see from this that many of these, in fact, most of these drawdowns are more than 50%. And so if you're using just simple 2-to-1 leverage and Bitcoin goes down 51.28%, you've lost more than 100% of your capital. And this is because leverage works both ways. It makes your returns going up much higher, and it makes your losses going down much higher as well. Here's another chart of Bitcoin's drawdowns, where the red is the drawdown and the white line is the price of Bitcoin. So I'll link to both of these charts in the description notes below so you can check them out. But this is what you really have to contend with if you're going to invest in Bitcoin over the long term. You have to expect these 50+% drawdowns, maybe even going down to 90% or more. If you're levered 2-to-1, as we said, a 50% drawdown wipes you out of 100% of your capital, and then anything more than 50%, and you'll actually end up, under the terms of your broker's agreement when you open the account, you'll actually end up owing your broker money that you don't have. So your account will go to zero, and then you'll owe your broker more money than that. So what kind of leverage are people using in the crypto space? I think you're probably already aware of this, but this is Binance allowing, I'm not sure if this is allowed onshore in the US, but at least at some of their exchanges, it's allowed 125x. Now, we've already talked about how dangerous just being levered 2-to-1. Imagine being levered 125-to-1. This was something that even SBF at FTX realized, and he moved to cut the FTX leverage that was offered to customers from 100x down to 20x. But again, 20x is still an absurd amount of leverage, and it's very unlikely that anyone made any money using that amount of leverage besides the exchange itself. Now, another terrible thing about using leverage is if you get it from an exchange like FTX, for example, and that exchange goes belly up, you go belly up as well because you're holding your Bitcoin there. And again, not your keys, not your Bitcoin. So what are we going to do in terms of talking about leverage ETFs? If we return to that comment, the commenter asking, I don't understand why you're not a fan of these leveraged ETFs. The first one, as we said, is the QQQs levered up 3x. So if it goes up 1%, you make 3%. If it goes down 1%, you lose 3%. This is much more leverage than 2-to-1. The other one was UPRO, which is the same 3x daily long leverage to the S&P 500. The problem is if you lever up stocks, it's one thing to using a little bit of leverage within the day for intraday trading, for day trading. Even then you have to be very careful. But if you end up levering up stocks, trying to capture something like this, you'll probably blow up along the way, even if you end up being right about stocks in the long term, in the same way that Weimar gold trade was very difficult to trade using any leverage at all. The other thing about leverage ETFs, and I've actually made a whole video about this, which I'll link to, leverage ETFs do a terrible job of tracking the underlying asset if held for more than a single day of trading. This is because the way that the compounding works, we talked a little bit about that before, where if you're down 10%, you need 11% to make it up. But this is a very subtle effect, and people don't realize this. If you hold leverage ETFs over the long term, they will not track the underlying asset by 3x or whatever you expect it to do. The only way you can make money with a leverage ETF is if the asset goes straight up without any dips along the way. And this never ever happens. It never even happened in Weimar. So feel free to use leverage ETFs for intraday trading, but I seriously do not recommend using them for holding them for more than a single day or even a couple days. I'll link to this in the description notes below, where I talk about why leverage ETFs work this way. And I believe that these 2x and 3x ETFs should never have been sold to the US public, and especially never approved by an SEC that is either too cowardly or too corrupt to even give us a Bitcoin ETF. It's completely irresponsible of people like Gary Gensler to allow these products to be offered 2 and 3x ETFs, which do not track the underlying very well over longer time periods, and yet they won't give us a 1x levered cash Bitcoin ETF in the US. Now, I'll say if you really want to trade stock indices or commodities like gold or crude oil using leverage, don't use these leverage ETFs. That's not the way to go. Instead, you will want to use stock index futures or commodity futures, crude oil futures, gold futures, etc., or stock index futures like index on the QQQs. In other words, the NQ or the ES would be the S&P Mini, for example. These are the way to go. And I actually used to trade a lot of futures back in the day before I discovered Bitcoin. So I will give you this shameless plug to a course that's still on my website, Learn to Trade Futures Like a Pro. If you want to trade futures and you want to do it in a responsible manner and understand what you're doing, I'd encourage you to watch either this video or do some more research on YouTube. But in this series of lectures, I go into depth how to trade, how to position size, things very important that you have to understand, like contango and backwardation and the cost of carry, etc. So be sure to check that out as well. After I just told you that you shouldn't trade using leverage, I'm pushing a futures course, but it's on the website. I figure people should at least know it's there. And like I said, whatever you do, you don't have to watch my course, but make sure you really educate yourself about futures if you're going to trade them. So what's the conclusion here? The conclusion is Bitcoin is absolutely the best asset to hold in a hyperinflationary environment, due to its absolute scarcity and censorship resistance, which is really important as well. You don't want your account to somehow be turned off, even though you're correct. This would be like having your gold confiscated in Weimar Germany, and so you wouldn't be able to participate with the upside. So Bitcoin is absolutely the best asset to hold in a high inflation environment, but it's absolute madness to combine the volatility of Bitcoin with any leverage whatsoever. Just go dollar cost average in, don't use Bitcoin futures, don't use leverage, don't use margin, don't trade in and out, don't take profits. Since only Bitcoin is real money, Remember, in this context we're talking about it, your local currency is dying. This is what hyperinflation is. And so taking profits out of Bitcoin into your dying local currency doesn't make any sense. It's not that you're actually making that much money in Bitcoin in a scenario like this. It's more that the fiat currency is collapsing. So you got to really control yourself. If you had taken profits on your gold position in the Weimar Republic, you ended up getting completely slaughtered. Even if you held on from 1 to 1,000,000, then when it went from 1,000,000 to 1,000,000,000,000, the purchasing power that you were holding completely disappeared. So with Bitcoin, you just want to buy and hodl, dollar cost average in, buy a little bit every day or a little bit every week or a little bit every month, and then just hold it, buy and hold for the long term. It's so simple, but it's definitely not easy. And people always try to complicate things, and they try to bring in leverage. They try to say, I'm going to trade altcoins in order to make more money on Bitcoin. If you believe in this hypothesis, and if you think this is where we're eventually headed, and if you understand that Bitcoin will do well even if the US doesn't hit hyperinflation and we just have inflation of the type we have, then you just want to buy and hold and be very patient. Put it away in cold storage and don't look at it until the decade is over. If you found this video helpful, be sure to hit that subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.